So we move to chapter 24, Introduction to Performance Management. We have 3 chapters in this area, 24, 25 and 26, so a fairly significant part of our MA course. And just as an aside, I sort of draw you to the options paper, APM. I have a good experience in teaching that. I'd certainly encourage you to consider, as you flow through your studies, opting for that paper, depending upon your career choices, because I think that's one of the more straightforward option papers. And what I mean by that is not so much the technical content, but the fact that of all the option papers as they stand right now, I think that's the one where exam technique can actually get you through. You know, let's say as opposed to ATX, the tax paper, where certainly very, very good knowledge of tax systems and the main tax heads is very, very important, along with technique. Just a thought on the outside for you to consider down the line. So let's take a look at this area of an introduction to performance management, and indeed what we mean by that. We'll start off by thinking about, or indeed talking about, objectives. In other words, the objectives of, let's say, a given business: operational, tactical, and indeed strategic objectives. Now, those words might not mean too much to you right now. Let me open that up by this cut and paste from the study hub. Really, broadly speaking, for any business, planning is 3 things, and indeed at 3 separate levels. Let's go from the top down. Now remember, we're trying to link this into objectives and indeed, profit, wealth maximization, etc. Let's talk about strategic planning. Now, I guess the words are a giveaway. We're talking about something pretty high level. As you see here, this involves longer term goals and indeed deciding how those goals will be achieved. This is C-suite stuff. This isn't factory floor. It's high level, senior managers, and we're talking about timescales of 5 to 10 years. So, in due course, obviously, as your career progresses, depending upon what route you take, I would suggest that you may well be involved in strategic planning for businesses, perhaps even your own business. But this is top-end stuff. Outside of that, let's go a little bit down. Now, we've said with strategic planning, this is really longer term. Now, tactical planning is more short term. This is really the area where we say, okay, we know what the strategic plan is over the long term. What tactics should we employ in order to turn those sorts of plans and goals into action? This is about more short term. Senior managers, yes, but also middle level managers would be involved here. In terms of timescales, probably you're looking at round about sort of 2 to 5 years or 3 to 5 years or thereabouts. So that's sort of middle level, if you will. Down the bottom we have operational. Now this doesn't mean it's unimportant. Operational planning is important because this is about day to day. This is about nuts and bolts. This is about what happens on the coalface, on the ground. And, it may well involve all managers. And certainly it's very much short term. Obviously, day to day, week to week, probably month to month. So you're probably talking about, 0 to 1 year, 0 to 2 years, or thereabouts. Now, in terms of the types of businesses, obviously for profit-making organizations where profit is a priority, the core objective across the board in those 3 areas of planning, certainly for sure, in terms of the strategic area, sometimes called the corporate area, it's about shareholder wealth maximization. Now, what do we mean by that? We're saying maximizing wealth. Well, who's the shareholder? Well, shareholders are the owners, okay? So let's just say we have a limited company. It could be a private limited company owned by maybe a few individuals or a family, or it could be a public listed company. At the end of the day, more often than not, those shareholders want two things. They want a dividend distribution, preferably annually, in other words, a return on their investment. And also they want capital growth. What do we mean by that? They want an increase in the value of their shareholding between, let's say, the beginning of the year and the end of the year. So wealth maximization means two things. Give me some money, give me some dividend, give me some distributions from profit, assuming you're making a profit, and indeed give me some capital growth. Okay? Now, flip side of that is not for profit. Now again, not for profit is important. Not all entities are about making a profit. Think charities, think hospitals, think generally NGOs or non-governmental organizations. They're not about a percentage profit increase month on month, quarter on quarter, year on year. They're about value for money. And indeed, I'd probably go a little bit further than that definition, which I've sort of cut and pasted from the study hub. I'd say, some of these not-for-profit organizations are about causes, about social causes. In essence, if we look at, let's say, a charity, let's say Children in Need, what they're about is, helping, bridge a gap between, I guess, what society provides in the normal sense of the word and what is actually needed. They're about helping disadvantaged groups, in this case, children, or might be the homeless person's charity. So, value for money, yes, because value for money really means, well, if you're getting donations from XYZ, from you, me, a another, then what we want is value for money. But we also want to help the, in effect, the disadvantaged. So that's an objective as well. Okay? So that's the first area for us, just understanding the different areas. Now, if we try and link that really through to performance measurement, and indeed what we mean by performance measurement, let me just bring this down so we can actually see what we're looking at. This, as you'll see, is just a cut and paste as I've done previously. Okay, so we're talking about the three main areas. In terms of the description, I'll just touch on those briefly. We're sort of going in reverse now, operational first. So short-term aims, yes. Now, the example here is from the example in the study of Winston's Football Factory. So really, let's say, for example, at operational level, it might be, as you see here, a given level of sales or answering the phone within a period of time, yeah. And in terms of perhaps an example, it might be target number of footballs per day or per week, or producing them. Okay. In terms of tactical, we saw up top, that's about sort of medium term, isn't it? Sort of 2-3 years up to say 5. And indeed outside of that, example might be, okay, what tactics are we employing? Well, let's compare. Yeah, variances. Let's compare what's actually happened over the last quarter, year, etc., with what we budgeted to happen. Because what we're trying to do is obviously keep on track in relation to our overall strategic objectives. Okay, and one of them is obviously to control costs, increase profits. Now, in terms of the example, it says or suggests calculate number of footballs manufactured in a period has increased, yeah, because we've input more time, effort into machine maintenance. So again, it's all in the sort of tactical area. In terms of strategic, obviously, as we said up top, this is about broad, 5 to 10 years or thereabouts. This broad direction, high-end C-suite stuff. Okay. Outside of that, in terms of the typical example, certainly profitability would be up there, and indeed, I guess for Winston's, it would be market share. Those are two significant indicators of certainly where the business is heading in the long term. If profits are decreasing, if market share is decreasing, this is an issue, and we need to do something about it. Okay. Let's move into this area of mission statements. Now, this links into performance measurement nicely, Because, if we're to, set up a business, one of the first things that we need to establish, or certainly broadly speaking, within the ACCA qualification, it would suggest that we need to establish is, what are we doing? What's our mission? In other words, what is our purpose? So this mission statement is a written statement that really describes the organization's aims. I would go as far as to say that a mission statement should really say or give a business's raison d'etre, to use the French words, its reason for being, and indeed how it hopes to achieve it. So this is important really to give everyone connected with the business, directors, employees, managers, etc., and indeed other stakeholders, to give them a feel for, well, what are we about? Okay. Generally, a mission statement would be published on a website. Okay. Now, once we've established the mission statement, we'd sort of be looking at other areas. If you think about it, this sort of area of metrics, objectives, goals, it's sort of drilled down, isn't it? Let's decide on the mission, and then let's go to goals and objectives. Let's head from there to critical success factors and key performance indicators. But what do we mean? What do we mean by CSFs? Well, we mean specific areas of the business that must be successful for an organization to achieve its objectives. So you can see the sort of drill down there, the sort of cascading. We decide on mission, objectives, goals first, and then we say, okay, I get that, but what are the key things that need to go right? I'd go as far as to say, that CSFs, my definition would probably be things that need to go right, basically. Things that need to go right, things that we need to get right, okay? Now, linked into that, and indeed below that, are KPIs. So if I know the things that I need to get right for me to be successful, to achieve my directives, let's break it down further. Let's go to key performance indicators. Let's drill down further. So here, we're talking about financial or possibly non-financial information or metrics to measure how well an organization is doing in relation to its CSFs. Okay? Moving on from there, in terms of, the sorts of things that will affect the achievement of KPIs, objectives, goals, CSS, etc. Well, there are a number, clearly, conditions or economic and market conditions. I mean, clearly the general economy, we have to think of, examples from the past of businesses' inability to perform when we have boom and bust cycles. And certainly, as you well know, and as I well know, we've had some pretty hairy boom and bust cycles, and some companies have hit the deck pretty quickly. So the idea of performance measurement and indeed management is certainly going to be affected by the conditions that business face in a broad sense. In addition to that, obviously competitors' actions have an impact. We have no control as a business over what our competitors do. They launch a new product. This could put us into serious trouble. We need to be monitoring these things. And a good tool in this area, although it's not mentioned here, and one that you're probably familiar with, is PEST, P-E-S-T, political, economic, social, and technical. Now, PEST is known as an environmental scanning tool. Now, just given the example that's on screen there, certainly PEST is going to help us assess competitors. We'll be looking out in the environment saying, well, what's going on in an economic sense? What's going on in a social sense? What's going on in a technological sense? So-and-so's just launched a product, have they? What's that? Well, it's a new R&D backed VC element of a component, etc., etc., etc. So you get my drift. Okay. Now, there are other tools and techniques to evaluate competitors' actions. For example, Porter's 5 forces that you probably heard of as well. So many ways to assess and evaluate competitors' actions. Linked into the area of PEST, certainly government regulation. That can affect us. It can affect our assessment of achievable corporate objectives. Absolutely. If regs come in, new, possibly in the area of the environment or employment law, etc., etc. Certainly that can have an impact upon us. So we need to be monitoring using effective tools. Another area here, and I'd sort of draw your attention to this word even, sustainability. Again, I do like to sort of, and I hope you don't mind, I do like to just reference just other areas of the ACCA qualification, and not so much just other subjects, but other themes. And what I mean by that is sustainability is one big theme in exams. Absolutely, in several different subjects. Understanding what it is, understanding what it means, understanding why it's important, not just from a performance measurement perspective, is important to you. Absolutely. So what does it mean? Okay, well, it basically means, the ability to meet current generation's needs without compromising future generations' ability to meet their own needs. Now, when we say needs, we're really talking about the world's resources. We're talking about people, planet, profit. We're talking about balancing future generations. Let's think about it. Do we want to be responsible for, let's say, the world's oil reserves running out? Do we want to be held responsible in 2024 or the beginning of the 20th century, the first 24 years, at being highly responsible or linked to serious global warming or climate change? You get the drift. So sustainability is important, and indeed linking back into performance measurement, perhaps we need metrics in this area. Perhaps we need to consider not just profit. Oh, are we meeting budgets? Are we meeting targets? What are we doing in terms of waste? What are we doing in terms of our emissions, etc., etc.? That's the idea. So three main areas here, as just mentioned. Environmental. Okay, how is our business affecting the environment? Maybe it isn't. If it is, how do we compare to last year? Linked into that, social. What's the impact of this business, our operations, our factories on local communities? Are we affecting them? Are we helping them? Are we inputting into local communities, or aren't we? Outside of that, certainly governance. And again, here's an area that's important to you in terms of your studies going forward. What do I mean? Well, governance, broadly speaking, means the way in which companies are managed and controlled. We're talking about, controlling the controllers. We know from just a cursory look at the news over the last 5, 10, 15 years, there is always some sort of story about poor governance, about companies, directors, managers, CEOs doing something wrong, doing something dodgy. One I saw recently, which is a terrible story, is about the whistleblower for Boeing. Okay, recently there was a whistleblower who was asked to testify because he was very, very concerned about what Boeing, the airplane manufacturer, had been doing for a number of years. He'd been with Boeing for 30 years. He was brought in front of an inquiry. This was a big, big story, and he committed suicide, I think last week or the week before. So, what are Boeing doing? Are their planes safe? Should we get on one? That's the area of governance. And indeed, what are Boeing thinking about their impact upon the environment and people's lives? I mean, okay, it's a slight tangent to sustainability, but you get my drift. Okay? Now, in terms of incorporating sustainability into performance measurement, all that we need to do, all that we need to understand here is what sustainability is as defined up top. Let's give it some level of priority. Let's not just focus on CSFs and KPIs that are strictly speaking geared towards profit or market share or our internal systems. Let's make sure that we have KPIs in this area, and let's adequately report on them. Let's be accountable in this area of sustainability. Okay. Moving from there, the balanced scorecard. And again, I said earlier on about referencing other areas. This balanced scorecard is going to come up in other subjects. Absolutely category. It is an examiner's favorite topic, not just in MA, in other areas. This is important. So I'm going to slow down a little bit here, make sure we get a good fix on this. What do we mean by the balanced scorecard? Well, the balanced scorecard, and I'll take you through the model, the image just there in a moment, is very simply a model put forward by theorists called Kaplan and Norton. Okay, now what it says is that the performance of an organization should be measured using financial and non-financial performance measures to give a more balanced view. Now, before we go through the image, what's the background to this? And why did Kaplan and Norton spend so much time researching and considering this whole area of performance measures, financial versus non-financial, etc., etc.? Well, the reason is that if we think back on financial accounting, if we think back on performance measurement over 50, 60, 80, 100 years, how is it done? It's done based on profit. It's done based on net assets. It's done based on a set of accounts that really are historic, backward-looking, based on accounting policies, and not necessarily what you would call absolutely bulletproof. What I mean by that is anyone can manipulate a set of accounts. I'm not talking about illegally. I'm talking about through the use of subjectiveness, through the use of different accounting policies, etc., etc. So really, what Kaplan and Norton have said in a nutshell is, in order to measure performance of a business, if you are simply using financial measures, I'm talking about profit, return on capital employed, return on investment, gearing, etc., etc., then you're crazy. Okay, you should consider other areas, because in today's modern business world, so many factors affect sales, affect revenue, affect profit. You need to consider them. So what did they say those factors are? Okay, 4 different perspectives. Now, before we sort of discuss each of the 4 perspectives, look right in the middle. It says vision and strategy. Now, what do we mean by those words? Well, in essence, what Kaplan and Norton say is, given your vision and strategy. Now, vision is sort of similar to mission. We discussed mission on the other side of the mind map. We said that a mission is sort of your overall aim, the business's purpose. Now, vision is sort of your ideal or preferred future. Think of vision as like, do you know what? If everything went perfect for this business in the next 20, 30 years, what would this business look like? Okay? So it's more sort of loose, a little bit airy-fairy in one sense, but Kaplan and Norton don't mean it in that way. What they're basically saying in the middle of this diagram is your overall sort of long-term objective, and indeed the strategy that's linked to that, should drive the metrics or the measurement across these 4 perspectives. Okay? So you should keep them in mind. Now let's deal with the easy one first, the financial perspective. What do they say about the financial perspective? Well, the financial perspective is really more of the same. In other words, they say, listen, we're not saying that financial measures or financial metrics are unimportant. We're not saying that return on capital employed, gross profit, net profit, interest cover, gearing, etc. We're not saying they're not important. They're a part of our balanced scorecard. So continue to measure those areas, of course. We're saying that they're one of 4. Let's look to the left-hand side, customer perspective. Now, what they suggest here is you need to know what your customer values, and you need to measure it. So, again, a simple example here, and there's a little bit more depth in the study hub, but obviously we're trying to summarize things within these mind maps and indeed within our videos. So, customer perspective, what do we mean? Well, I'm thinking about my customer, thinking, what do they want? Well, they want quality. How do I measure that? Well, let's get some feedback from them. Let's send them a survey. How many times do we get sales returns? Yeah, let's measure that, etc., etc. So the customer perspective really means put your customer hat on, be a customer, and really establish what the customer wants and set metrics subject to the business that you're in, subject to the industry in those areas. Right hand side, internal business processes. Now, again, that does what it says on the tin. Any business is made up of a set of processes, really, isn't it? Every business is made up. I mean, a simple example, you book a flight. You use a booking process. You go on to Skyscanners, you go on to a particular website, and the functionality within the booking system allows you to book a flight. Now, how many times, let's say, have you tried to buy something or book something, whether it's a flight or not, and for some reason or other, there's been a glitch? How frustrating is that? I find that with booking flights because I travel a lot, and I find that one of the things that I find really, really annoying is the price of the flight between the point of me literally clicking my name in and me using my card details can double sometimes. So it could go from $200 to $450. Now, how? I think there's a good reason for that. Now, is that part of a slightly iffy or unusual business process? I don't know. Seems maybe that might be something else. But again, you get my idea. We want businesses to have efficient and effective internal business processes. So why don't you measure it? Why don't you measure the time taken between the customer arriving on the site and between that point and them checking out? Or what about, let's say, a hotel check-in? How long does it take for a company or for a customer to check in at the hotel? Is there any way that you could improve that, etc., etc., etc.? So in essence, internal business processes simply means a business is full of processes. What are the important ones? Are they good? Do they work properly? Do you get complaints, etc., etc.? Learning and growth, again, does what it says in the tin. Really, let's set metrics in the area of learning and growth. So, for example, learning, a simple one, obviously, is training. Are we spending money on training our staff? And if so, how much did we spend in the last quarter or the last year? And how does that compare to what we spent at this time last year in this quarter or in the last year? With growth, we're a business that's involved in tech. Let's set targets in terms of launching or developing and launching new products. Last year we did 3. This year we've done none. Why? What's the reason? Let's look into this. So you get the drift of it, okay? We can build on our knowledge from the last few minutes by doing questions, and if you have the time, certainly this is an interesting area to look at, this area of Kaplan and Norton's balanced scorecard. Let's do some questions too, obviously. We'll learn from them. Okay, so I hope that made sense. Let's move on to this next area and just touch a little bit more on non-financial information. Now, we saw up top with Kaplan and Norton that they're one of the sort of early proponents of bringing in non-financial information into performance measurement. So really, what you will find, and you probably agree with that, is certainly that non-financial indicators can provide early warnings, more useful early warnings. The idea that, let's just say that you're running a retail shop, let's say it's a large store or whatever, and you see that footfall over the course of the last month has fallen, which obviously you're not even getting people browsing. Why is that? Well, maybe there's a recession. That's certainly this week, this month, or over the course of the next few months going to lead to a fall in sales, but I won't know total sales until I produce my management accounts or even my financial accounts. So really, non-financial indicators can give you a sign, an earlier sign. If we keep getting complaints about, let's say, a lack of stock, we know that's an issue. If we are bombarded over the last month with complaints about quality, we know that's an issue, etc., etc. So, in terms of benefits here of both financial and indeed non-financial performance indicators, I guess, first things first, the idea of sort of hidden results, as it were. Certainly, we know human nature. With financial results, it's a little bit easier to, if you will, manipulate financial information. It's not, as I said earlier on, overly difficult to manipulate a set of accounts. I don't mean illegally. I mean just by using, let's say, different accounting policies. There's a great old saying that you can make a set of stats or a set of numbers say what you want them to say depending upon how you present them. Okay? So bringing in non-financial sort of does something to perhaps resolve that area. What about inability to locate problems? Certainly non-financial PIs can bring attention to an area before financial performance measure can. So as we said up top, when we're talking about, let's say, footfall in a retail store, you can notice that immediately before you prepare your accounts next month. You can see, we just don't have the footfall that we normally have at Christmas time or whenever. Okay. Next area for us, and this depends on the person, but I guess what we're talking about here when we talk about ease of understanding, certainly, non-financial members of staff might find non-financial information a little bit more easy to understand. They're not trained accountants, they're not trained finance people, so we can't expect them necessarily to understand how to read a performance report or how to read a set of financial statements, for sure. Next area is lack of balance. I mean, that sort of goes without saying in one sense when we consider, let's say, the balanced scorecard. Because really what the balanced scorecard does is bring in balance across three other perspectives, learning and growth, internal business processes, and indeed customers. So we're talking about, obviously, a more balanced view. Okay. Now, in terms of the real detail on the perspectives, these are just, as you see, a sort of a cut and paste. Now, I've taken you through some examples up top, and I'll let you read these in detail. But you can see, if we look up top at the financial perspective, we don't really see anything there that surprises us, do we? I mean, the financial perspective is the financial perspective. This is about, if we assume a for-profit business, and indeed a business that has shareholders as opposed to, let's say, a sole trader or a partnership, really talking about the sorts of things, what you might call the sort of big numbers. If I'm looking at a set of accounts, I'm always looking for, well, what are the big numbers? What's the sales? What's the gross profit? What's the return on capital employed? And indeed, are they issuing dividends, etc., etc. So there's nothing really unusual for me under the financial perspective. What about the customer perspective? Let's dwell on this just a little bit in case you didn't really get a good feel for what I said up top. We're talking about how to satisfy the customer. What do we need to do to get customers to buy our products? So look at the little metrics that they reference here. Returning customers, satisfaction surveys, complaints from customers, customer referrals, sign-ups and loyalty cards. All of these things give you, if you will, a non-financial feel as to what's going on. In one sense, as I said up top, you're sort of putting your customer hat on. I think, right, I'm a customer, right? If I was happy, how would I respond on this survey? Would I be complaining all the time? Would I be referring people, etc., etc.? So you get an idea there. In terms of the business perspective or internal business processes, really talking about process efficiency, really, aren't we? So, things like quality, things like cost per unit, utilization of resources, etc., etc. A business is about processes. Absolutely. We need to have efficient processes. Learning and growth, again, you could sort of split it into two. There are linked, the reference here to, a measure of growth might be how much sales revenue relates to new or revised products. Other indicators, market share perhaps. Hasn't mentioned training, which that would be my go-to one in terms of learning. It's easy to think of, easy to put down on paper. Okay, so that's a little bit more depth in relation to the balanced scorecard. Let's take a look at this next area of sort of measures of financial success. Okay, well, certainly, financial success, when we think about the financial perspective, a la Kaplan and Norton, the balanced scorecard, it's got to come from the other three areas. If your customers are not satisfied, if your processes are really iffy, glitchy, rubbish, if you're not focusing on growth, new products, training, etc., then you can forget about financial success, I would suggest. Okay, so an example of that, increased customer satisfaction clearly has to lead to increases in sales revenue, I would have thought. This is just a reiteration of what we saw down below. Yes, it is. We are. Okay, so that shouldn't be actually there. My apologies. I should take that out. I will take that out. So let's focus and sort of conclude really on the sort of upsides and downsides. Okay, so we've said, and I've tried to really sell the balanced scorecard to you as a very good way to look at performance measurement. What would you say are the sort of advantages? Certainly, one, balanced view. Another, three areas. Outside of that, short term to long term, certainly what the balanced scorecard does is encourage a more long term view. Absolutely. I mean, think about it. If we're talking about, let's say, metrics such as market share, that's very much long term. If we're talking about learning and comparing, let's say, new products launched this year or revenue from new products this year to last year, that's a sort of a longer term view than next week. Outside of that, congruence. Well, we hope so. What do we mean by that? We know that with congruence, we basically mean the idea that everyone in the organization, top, middle, bottom, is working towards the same overall objectives. We're trying to get alignment, and really what this particular branch suggests is by bringing in metrics that have more balance to them across a range of different areas, it's highly likely that you're going to get more buy-in than just considering financial measures. Some people may not understand ROCE, they may not understand gearing or interest cover, etc., etc. Now, there is a flip side to it, disadvantages. I mean, clearly, if we're having to come up with measures in other areas, three other areas, it's going to take time and effort on a number of departments' parts. So that's an issue. We need to consider cost v benefit. In addition to that, subjectivity. I mean, who's to say that we have the expertise in-house to choose the right measures? I mean, what if we don't? What if the 2 or 3 processes that we focus in on are really not what drives revenue or not what drives customer satisfaction? It's a matter of opinion. Now, next one, conflicting. This is an important one, I think, because you could get perspectives that conflict with each other. For example, if we're considering the financial perspective and really talking about ROCE or return or profit on capital employed, or just generally about profitability, gross profit, net profit, etc. If we're also setting metrics in the area of investments in growth or investments in training, then in one sense we're sort of robbing Peter to pay Paul. We're saying under the financial perspective, well, profitability is key. We've got to increase profit margins by 10% in the next 6 months. But we're also saying we've got to uplift our training costs or invest more in R&D. So you can see that there could be, not always, but there could be some sort of conflict between different aspects of the balanced scorecard. Last point here, difficult to interpret. Well, again, this is a matter of opinion. I guess it depends on the person. So we've said up top that really including non-financial measures, broadly speaking, is a good idea. Because some people may not understand financial measures, but it could be that the measures chosen may be difficult for everyone to understand. They may be a little bit more complex. And indeed, it may well be that we choose quite a few different metrics under each of the 4 banners or each of the 4 perspectives. That's a lot of information, and it could be confusing. And this could create difficulties in an overall performance measurement sense, or performance management even. Okay. Final point here, just in relation to short-term v long-term. I mean, obviously we're talking about measuring success in one way, measuring results, measuring performance of people. Short-termism is another one of those buzzwords, those important buzzwords that you need to remember. What does it mean? Well, how really maybe a division, department, etc., the short-term performance can be considered more important than the long-term, because it often forms the basis of a manager's reward system. Okay, let's break that down into something that makes sense. What we're saying is blinkered view. We're saying that it may well be that managers make decisions, possibly dysfunctional decisions, or act in a dysfunctional way because their quarterly bonus or annual bonus is coming up for renew. And so rather than thinking about long-term, rather than thinking about the long-term objectives of this business, they may make decisions that actually affect the long-term negatively. So, for example, they may not invest in equipment because they think, well, no, I'm going to be over my budget. If we buy that new machine that I know that we need, I don't want to be over my budget because that may affect my bonus. So, short-termism, let's learn that word, learn what it means. It just means blinkered view and really an adherence to short-term stuff as opposed to thinking in the long term. Okay? So that concludes this first chapter. I hope that you found that helpful. Sorry for the slight error on the mind map there. I'll cut that out on the left-hand side before it goes up on the platform. An interesting chapter, the first of 3, as I've mentioned, and indeed an interesting area, and an area that you're going to see elsewhere in your ACCA studies. So in particular, get a fix on the balanced scorecard. Okay? Understand that, and also understand in the first branch, excuse me, the difference between strategic level planning, tactical level planning, and lower level operational level planning. Okay, listen, thanks for listening. Nearly there at the end of the course. Well done for sticking with it. Keep plugging, keep working. We're nearly there. Cheers.